Well, good morning, good afternoon, wherever you might be listening from. It's always a pleasure to chew the fat a bit about investing in business, which, truth be told, are just about the only things I've really cared to spend my time on since I was a little tight delivering newspapers back in Omaha. Most folks probably know my name because of Berkshire Hathaway, and that's certainly where a lot of my journey has played out. But let me tell you, it wasn't always smooth sailing. And if you think I've got all the answers, well, you'd be sorely mistaken. I've made more bonehead mistakes than I care to count, and sometimes those mistakes cost me billions. Yes, billions with a B. I remember one particular whopper back in the 1960s, a real classic of stubbornness and pride. And it actually involves how Berkshire Hathaway, the textile company, became the Berkshire Hathaway we know today. My partnership, Buffett Partnership Limited, had started buying shares in, it was a dying textile mill up in New Bedford, Massachusetts. Now, I knew textiles weren't a great business. It was capital intensive, unionized, and commodity-like, meaning no real competitive advantage, but the stock was cheap, trading below its working capital. And the CEO, a fellow named Seabury Stanton, had offered to buy back some shares. I was looking to make a quick buck, maybe a half point or so, selling back my shares to the company. In 1964, Seabury came to Omaha. We sat down and he made an offer to repurchase some of our stock. I believe it was for $11.50 a share. I agreed and shook his hand. A few weeks later, the tender offer arrived in the mail, but the price was $11, a quarter of a dollar less per share. Now, that might sound like a small sum, maybe even insignificant to some folks, but to me, it was a breach of a handshake agreement, a matter of principle. I was dumb enough to get mad. Instead of selling, I started buying. I bought more and more of Berkshire Hathaway, eventually gaining control of the company, all because of a fractional difference in an offer price that had bruised my ego. What a bonehead move that was. I mean, think about it. I was so caught up in the slight in winning the petty argument that I sank my partnership capital into a business that was going nowhere fast. For the next 2 decades, I tried to make a silk purse out of a sow's ear, investing good money after bad into that textile operation. We poured capital into new machinery, new management, everything we could think of, trying to turn it around. It was like trying to shovel smoke. Every dollar we put in seemed to just disappear, swallowed by an inherently terrible business model. The returns were abysmal and the opportunity cost, well, that's almost painful to calculate. Charlie always told me, Warren, you can't make a good deal with a bad person and you can't make a good business out of a bad business model. And he was absolutely right about Berkshire's textiles. My stubbornness cost me dearly. If I had simply taken that 11 buying 37 dive and put it into an average S&P 500 fund, let alone a truly wonderful business, the compounding ain't down over those decades would have been astronomical. I estimate that mistake, getting emotionally invested in a bad business because of a bruised ego, cost Berkshire about $200 billion over the years. Yes, you heard that right. $200 billion in lost opportunity. That's a pretty expensive lesson, wouldn't you say? Here's what I learned from that mistake, and it's a lesson that Ben Graham, my old professor at Columbia, tried to drill into my head from day one, though it took me a while to truly internalize it. You want to own wonderful businesses, not fair businesses at wonderful prices, but wonderful businesses at fair prices. And you want to buy them when they're cheap, offering a good margin of safety. What is a wonderful business? It's one with a durable competitive advantage, a moat that protects it from competitors. Think about a castle with a wide, deep moat. That's what you want your businesses to have. Investing isn't some complicated rocket science. It's really quite simple, though not easy. It's about figuring out what a business is truly worth, its intrinsic value, and then buying it for less than that. That difference, that cushion, is your margin of safety. If you buy a dollar for 50 cents, you've got a lot of room for error. Ben Graham always emphasized this, the importance of purchasing something for significantly less than its calculated value to protect against both miscalculation and adverse events. It's like buying a farm. You don't buy it just because it's cheap. You buy it because you understand the crops it grows, the land's productivity, and what you can reasonably expect to earn from it over time. Charlie and I, we're always looking for those kinds of businesses ones that are simple to understand, have a consistent operating history, favorable long-term prospects, and are run by honest, competent. We're not looking for the next hot thing in some cutting edge technology. If I don't understand it, that's what I call my circle of competence. My dad, he always said, stick to what you know. It sounds simple, but it keeps you out of a lot of trouble. That textile mill wasn't in my circle, not really. I knew it was cheap, but I didn't understand its long-term viability, and it turned out there wasn't any. This understanding of wonderful businesses really started to click for me in the late 1960s, thanks to Charlie Munger nudging my thinking away from just cigar butt investing, buying deeply discounted, struggling companies for one last puff. Charlie got me to see the immense power of owning a truly exceptional business for the long haul. Take See's Candies, for example. We bought it in 1970. It was a well-known brand on the West Coast with incredible customer loyalty and a history of profitability, but it wasn't a growth stock by any means. Now, when we bought See's, it was making about $4 million pre-tax. So we paid a little over 6 times pre-tax earnings, which seemed like a fair price for a business we understood. What we learned was that See's had something special, pricing power. They could raise prices a bit each year without losing customers because people loved the product and associated it with special occasions. That meant we could generate significant cash flow and reinvest it or send it back to Omaha to buy other businesses. See's didn't need much capital to grow, which is a hallmark of a wonderful business. Since then, See's has generated over $2 billion in pre-tax profits, all from that original $25 million investment. Think about that. $25 million turned into $2 billion and counting, just by owning a simple business that understood its customers and provided a quality product. It's a perfect example of what Charlie and I mean when we talk about a wonderful business at a fair price. We didn't need to do any fancy financial engineering. Just let a good business be a good business and enjoy the compounding returns. It reminded me that the real money is made not in buying and selling, but in waiting. Per crack, rack, crack. Another great example is Coca-Cola. We started buying Coke stock in 1988, eventually investing about $1.3 billion. At the time, the market was full of excitement about new technologies. But Charlie and I looked at Coca-Cola and saw a global powerhouse, a brand that was loved everywhere, with a simple, understandable product that people consumed repeatedly. It had an enormous moat. Its brand recognition, its distribution system, its place in people's daily lives. No matter where you went in the world, people knew Coke. That $1.3 billion investment is now worth, well, many, many times that. Plus, we've received billions in dividends over the years. In 1994 alone, we made more on our Coke investment than our entire initial purchase price. The beauty of it is it's not complex. It's just sugar water, but it's sugar water with a powerful, enduring brand that connects with billions of people. We bought it because we understood the business, believed in its future, and held on to it. Our favorite holding period is forever, and Coke is a prime example of why. Now, for any young investor today, or anyone really, my advice is pretty straightforward. You don't need to do extraordinary things to get extraordinary results. What you need is patience, discipline, and the ability to think independently. Don't listen to the talking heads on TV. Don't follow the crowd, and certainly don't get caught up in fads or speculative bubbles. Most people think you need to be constantly active, trading in and out of stocks, checking prices every hour. But actually, the less you do, the better off you often are, provided you've done your homework up front. When I was running my partnership in the 1960s, I saw people making money hand over fist in speculative ventures, things I didn't understand. It was tempting to jump in, to join the party, but I stuck to my knitting, buying businesses for value, much to the chagrin of some of my partners who wondered if I was missing out. It's hard to sit still when everyone else is making what looks like easy money, but resisting that temptation is crucial. The market is there to serve you, not to instruct you. It's offering prices every day, and most days you should simply ignore them. Wait for the fat pitch, like in baseball. You don't have to swing at every ball. What I tell my younger self and what I tell my grandchildren is to cultivate good habits early on. Read, read, read. And I spend 80% of my day reading annual reports, biographies, anything that helps me understand the world and businesses better. It's how you build knowledge brick by brick, understand accounting, learn how to analyze a balance sheet and an income statement, and most importantly, develop an emotional temperament that allows you to be rational when others are emotional, be fearful when others are greedy, and greedy when others are fearful. That's a truism that never changes. This applies to any business, not just investing in stocks. Whether you're starting a lemonade stand or running a giant corporation, what really matters in business is finding something that provides lasting value to customers, building a competitive moat, and having sensible, honest managers. We've owned so many different kinds of businesses at Berkshire, from insurance with Geico and National Indemnity, to furniture with Nebraska Furniture Mart, to utilities with BNSF and Berkshire Hathaway Energy. Each one has its own characteristics, but the underlying principles are the same. Durable competitive advantage, good management, and a sensible economic proposition. Take Geico, for example. We bought the whole company in 1995, but I first bought a chunk of it back in 1951 after meeting Lorimer Davidson, who taught me about its low-cost, direct-to-consumer model. It was a wonderful business then. It hit a rough patch in the 70s where I famously underestimated its troubles, but it remains a wonderful business today. Ajit Jain, who runs our insurance operations, is an absolute genius, and he's a testament to the power of finding extraordinary talent and letting them do their job. You don't need to be a genius to build a great business, but you do need to understand how to recognize and nurture one. But that's not the only lesson I learned the hard way about human nature and the market's folly. This reminds me of another time when I let emotion get the better of me, driven by something other than just a bruised ego, the desire to save a failing business. It's a classic mistake for many entrepreneurs and investors, thinking you can fix what's fundamentally broken. The next mistake cost me millions more, not just in opportunity cost, but in actual capital deployed. Back in 1993, we made what I thought at the time was a sensible acquisition, Dexter Shoe Company. It was an old line New England shoemaker, seemed to have a good brand and was still profitable. We bought it using Berkshire Hathaway stock rather than cash, which compounded the error. I gave up shares in Berkshire Hathaway, which were then worth about $433 million for Dexter Shoe. What I failed to see was that the moat around Dexter was rapidly disappearing. Cheap imports were flooding the market, and the brand loyalty and manufacturing advantages that Dexter once enjoyed were eroding fast. What looked like a steady business quickly became a terrible one. We tried to make it work, but the fundamentals were against us. Eventually, we had to shut it down. That $33 million worth of Berkshire stock I gave up for Dexter would be worth many, many billions today, well over $50 billion if held. It was a dreadful mistake, a real clunker, and it taught me yet again that it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. In this case, it was a fair company at a fair price that rapidly became a terrible company. The lesson, plain and simple, is that you can't defy economic gravity forever. A business with no moat, no real competitive advantage, will eventually succumb to competition. It's like trying to protect your sandcastle from the tide. Eventually, it's going to get washed away. I've been doing this for over 80 years, and one truth remains constant. The market is a device for transferring money from the impatient to the patient. And a big part of patience is not getting involved with businesses that are swimming upstream against powerful economic forces. This is where Charlie really excels. He has an incredible ability to look at a business and instantly grasp its underlying economics, its competitive position, and its long-term prospects. He's a master at seeing through the noise and focusing on what truly matters. We've sat in our office in Omaha, just a few miles from where I still live, in the house I bought for $31,000 in 1958, and talked through countless potential investments. He's the one who hammered home the idea that a truly great business can be worth paying a premium for. If you buy a truly great business, its compounding power will make up for a slightly higher initial price over the decades. Charlie's wisdom also extends to human nature. He always points out the folly of incentive caused bias. People respond to incentives, and if you set up the wrong ones, you get the wrong behavior. This applies to management, to markets, to just about everything. Understanding these basic principles of human psychology, how people behave, how markets are driven by fear and greed, that's just as important as understanding balance sheets. Speaking of markets, the Mr. Market metaphor that Ben Graham coined is perhaps the most useful concept any investor can grasp. Imagine you own a small part of a business. Every day, a fellow named Mr. Market shows up at your door offering to either buy your share or sell you his. Sometimes he's ebullient, offering high prices because he thinks the future is bright. Other times he's depressed, offering to sell you his shares for a pittance because he sees nothing but gloom. The crucial thing is, Mr. Market is your servant, not your master. You don't have to listen to him. You only transact with Mr. Market when his offer is attractive to you. If he's offering too little for your shares, you don't sell. If he's offering to sell his shares too cheaply, you buy. Most of the time, you do nothing. You ignore his daily moods and focus on the underlying value of the business you own. This discipline, this emotional detachment from the daily gyrations of the market is a monumental advantage for long-term investors. It's how we were able to build our positions in companies like American Express after the salad oil scandal in 1963, when everyone thought the company was going under. We understood the power of the American Express brand and its core business, even if a small part of it had made a terrible mistake. While everyone else was panicking and selling their shares for pennies on the dollar, we were buying with conviction based on our understanding of intrinsic value, and a margin of safety paid off handsomely. It wasn't about being smarter than others. It was about being more rational, more patient, and less swayed by the prevailing emotions of the market. Another time this principle came into play was during the financial crisis of 2008. The world felt like it was ending and fear was rampant. Companies like Goldman Sachs and GE were struggling and the financial system was on the brink. Charlie and I saw opportunity. We invested billions in preferred stock and warrants in those companies with favorable terms. We were greedy when others were fearful. It wasn't about predicting the exact bottom, but about recognizing that great American businesses, even if temporarily in distress, would eventually recover. That required a deep belief in the underlying strength of the American economy and an understanding of the long-term compounding power of good businesses. When I was a kid, back when I was filing my first tax return at age 13, claiming my bicycle as a deduction for my paper route, I saved every penny. My dad, he taught me the value of money and saving. He ran a stock brokerage during the Depression, and he saw firsthand what true financial hardship looked like. He ingrained in me the importance of avoiding debt. I've never borrowed significant money, not for stocks, not for personal consumption. That discipline keeps you from being forced to sell at the wrong time, and it allows you to be opportunistic when everyone else is in trouble. That's one of the cornerstones of Berkshire's philosophy, maintaining a huge cash hoard. People often criticize us for holding so much cash, saying it's lazy capital, but that cash is our dry powder. It allows us to act decisively when opportunities arise, when market is depressed, and offering wonderful businesses at bargain prices. It's the ultimate margin of safety for the entire company. You don't know when the rainy days will come, but they always do. And it's best to be prepared with a big umbrella. My reading habits are also key. People ask me all the time, Warren, what's the secret? And I tell them, I sit in my office in Omaha and I read hundreds of annual reports every year, 10Ks, industry journals, biographies, anything that helps me understand how businesses work, how people make decisions, and how the world functions. The more you read, the more you learn, and the more likely you are to recognize a good idea when it comes along. It's not about being quick, it's about being thoroughly informed. One of the more recent developments in our thinking influenced heavily by necessity and opportunity, is our investment in Apple. Now, I've always said I don't invest in tech because I don't understand it. And for a long time, that was true. I still don't understand the intricacies of chip design or software development. But Charlie and I came to view Apple less as a tech company and more as a consumer products company with an incredible brand and ecosystem. People love their iPhones. They're central to their life. It's like it's utility in many ways. Once you're in the Apple ecosystem, it's sticky. That pricing power, that customer loyalty, that brand strength, those are the qualities of a wonderful business that we understand. It's a bit outside our traditional comfort zone, but the underlying business principles are the same ones we've always looked for. We made a big investment in Apple starting around 2016, and it's been a truly remarkable performer for us, demonstrating that sometimes even an old dog like me can learn a new trick or at least reframe an existing concept to fit a new opportunity. We've always tried to buy businesses so wonderful that an idiot could run them, because eventually one will. And that's a bit of a joke, of course, but it points to the importance of a durable moat that protects a business even through periods of less than stellar management. But when you find a business with a great moat and truly outstanding management, well, that's a home run. People like Rose Blumkin, Mrs. B, who started Nebraska Furniture Mart, or Frank Rooney at H.H. Brown and Acme Boot. They built incredible enterprises because they understood their customers and their business intimately. Over at Berkshire, we try to create an environment where these talented managers, whether it's Greg Abel leading our non-insurance operations or Ajit Jain running the insurance side, can flourish. We give them autonomy, we trust them, and we let them do what they do best without interference from Omaha. It's a decentralized model that attracts and retains great people because they feel like they're running their own business, not just being another cog in a giant corporate machine. The annual shareholder meeting in Omaha, that's another tradition that brings all this to life. We used to have a few hundred people in a small room, and now we get 40,000 shareholders from all over the world showing up to hear Charlie and me ramble on for 6 hours. It's a chance to explain our thinking, acknowledge our mistakes, and share our philosophy directly. A shareholder once asked me, "What's the best investment advice you can give?" And I simply said, invest in yourself, build your knowledge, improve your skills, and cultivate good habits. That's a compound interest machine no market can beat. After over 80 years of doing this, here's what I know for certain. Investing successfully doesn't require a stratospheric IQ, complex algorithms, or inside information. I've seen people with 60 IQs fail spectacularly because they lack emotional control or intellectual independence. It really comes down to a few basic common sense principles applied with discipline over a long period. Price is what you pay, value is what you get. Never forget that. I'm 94 now, and if I could tell young investors one thing, it's this: start early, learn continuously, and practice extreme patience. Focus on understanding businesses, not just stocks. Think like an owner, not a speculator. Buy a diversified portfolio of wonderful businesses at fair prices, and then sit on your rear end. Let compound interest, that eighth wonder of the world, do its magic. Don't check the score every day. The greatest enemy of a good plan is the lure of an even better, but riskier one. And always remember rule number one, never lose money. Rule number two, never forget rule number one. What I mean by that isn't that you'll never have an investment go down, but that you should protect your capital by only investing with a margin of safety in businesses you truly understand, that have good long-term prospects, that keeps you from making permanent capital impairment. Don't put yourself in a position where you're forced to sell. I'd never bet against America. This country has an incredible capacity for innovation, for adaptation, and for generating wealth. There will be bumps in the road. There always are, but over the long term, the American economy has proven to be incredibly resilient. So be optimistic, but be prepared. Invest in America, invest in good businesses, and let time be your friend. You don't need to be brilliant. You don't need inside information. You just need patience, discipline, and a sound temperament. That and a good partner like Charlie Munger, if you can find one.